Hey there, it's Phil Ratcliffe with Rebel Financial and Tony Jones here, our tax expert, and we are going to just dig in to some of the tax changes and give you some practical things. So I'll turn it over to Tony and let him run with it and hopefully give you guys some insight.
All right. Well, good morning. So I want to talk a little bit first about the tax changes in general, but then give you some specifics and then go through some examples as well. So the tax code has been made easier. I like showing this form because this helps me. So let's go to this.
So we're going to share the screen.
Going to share the screen right here. This is basically what the 1040 looks like now, all right, as opposed to like a page and a half of things before. So in one sense, it has been made much easier. So, but there's been a lot of opportunity made to really be able to plan for things as well, because even though we have a lot less here, the underlying planning can be made a lot more. All right, so let's come back to us here, and I'm going to go through a few things. So here are just some of the tax breaks, because it's good to know what these are in general, but make sure you're talking to whoever's helping you with taxes to see how that applies to you. So the examples we're going to talk about will be good because there's going to be a doubling of the standard deduction. So many people, you used to weigh what was higher, the itemized or the standard. In most cases, for a lot of people, especially if you own a home, the itemized would be higher. But now the standard is going to be higher, so most people end up taking that. However, everybody got a personal exemption for everybody in the house that was a dependent. And so, or the head of household, that has gone away. So that is going to have some effect on people as well. However, what has gotten better is the child tax credit. So we'll go through that. And in addition to that, you also get credit for other people in your household who do not apply, who do not fit into the criteria for that. So a lot of give and take in this whole thing. So anyway, some of the things real quick. There's a limit. You've probably heard this, a lot of going back and forth. The SALT limitations, state and local taxes is now at $10,000. There was no limit before. Home mortgage limits, if you are going to itemize, you can go up to a total value in a home or a second home in total of $750,000. And I'm going through these quickly because there's a number of them. Charities, actually they talked about charitable contributions going away, but it actually went from 50 to 60%. So they have some more. And one great benefit, as you hit 70 and a half, you could actually write a check out from your RMD directly. This is important. You got to make it directly to a charity, and it won't ever count on your income. So you'll get the full benefit of that. So if you have to take an RMD and you are using charitable deductions, well, just make that check directly out to the charity and it won't ever count in the income. So it's a really great benefit. So take advantage of that. Casualty and theft. Unfortunately, when something bad happens, you used to get a write-off for this, but now it has to be a federally declared disaster area for that to take place, so not the normal. So miscellaneous deductions are gone. Those included, as they affect us as well, investment expenses. The big one for most people might be unreimbursed employee expenses. So if you are an employee and you fund some of the things you do, you will no longer get that deduction, all right? So some other things, tax prep fees, a number of things, those are gone. Moving expenses, you do not get those anymore as the old rules apply, unless you're in the military. So at least we're honoring those folks who have to move, because of the changes. Alimony, this will affect a lot of people. And by the way, the alimony is grandfather claused in. It used to be that when you paid alimony, not child support, but alimony, you would be able to write that off and the person receiving it would have to include that as income. That's no longer the case going forward.
And if you're divorced, like, what was it, December 31st of last year and back, you still get the old way.
If you were grandfather clause dead. Yeah. And that's the one point.
And now you get divorced this year and forward, it's the opposite.
So make sure your lawyer's aware of that, so that will come into some negotiations.
They know, right?
Right, they're better.
Red flag if they don't know that.
We used to have a couple different options for funding education. The Coverdell was commonly used for school, for primary school, and then 529 was for college and post primary school. But now we have the 529 is going to take care of all of that. and the covered Dell is gone. So don't fear, if you still have the covered Dell, you'll still be able to use it. You just can't make those contributions.
And we're posting a link, so if you're watching this online, you can see a summary of all these changes inside of there. Because, I mean, there's a lot of them, right?
There's a lot. I'm flying through these because there's so many. So, yeah, so it is a very good link, and so take a look at that, and but also talk to your tax accountant about that as well. So a few more. One of the interesting ones to me was the bicycle commuting. You used to be able to get up to $20 a month for a discount. I did not know that, but that's gone. So if you're trying to buy a bike to take advantage of that $240 deduction annually, that's gone. So there's a number of them. A number of them more. The state taxes double. It was 5.5 million. Now it's like 11 million. So a few new rules. I won't go into all of them. So make sure you're talking to your tax people about it. A couple things really quick that haven't changed, just so you know. Teachers can get reimbursed, some money for the money they spent. That hasn't gone away. Electric car, you get that credit. That is not changing. Adoption assistance, that's not changing, and student loan deductions, for the interest, that's not changing as well. So anyway, that is about the personal side of things, and I will give some examples here in a moment. Lastly, I'll talk about major deduction for businesses. And when I say businesses, I'm not talking about C corporations, because C corporations already, because of this tax change, are getting a 40% reduction in their tax rate. So this is for everybody else who owns a business, basically except for the C Corp and for W-2 employees. This isn't for you, but you're going to get what's called a 199A. That's the tax code. It's qualified business income, QBI, and in many cases you're going to get a 20% write-off on that business income. And I'll go through a couple of examples of that as well. All right, so that's that. So let me come here to the screen and go through a couple of individual examples and then a business example as well. Okay? So here's
sharing screen again.
Yeah, we're sharing the screen. So I'm going to talk through this, but a simple example here. In 2017, this couple who had 2 children, and they're filing married jointly. They have a 15 and 12-year-old. So those kids, they're okay to get the tax credit for children. 50,000 income. They itemize their deductions, so 18,000. They do get 4 personal exemptions, so they would have had taxable income of $15,800. All right, but they also have that child credit of $2,000. So they owe on that. The tax bill would be $1,580, except they're also going to get that tax credit. So now they're going to get a refund of $420.
This is just a plain generic example, and so obviously you got to see whether obviously for this couple whether the earned income tax credit would be better or the child tax credits, right? But we're just using this because it illustrates, I think, an important point and change. Yep. And you'll see on every one of these examples that Tony's made here is it's kind of showing you what the difference was from 2017 to 18, because I think that is like one of the biggest questions we get from people is like, what is the change going to do for me, right? And so these next 3 examples, I think we have 4, are just giving you really simple kind of plain vanilla things. Obviously, people's lives are a lot of times more complicated, but just to illustrate some of the changes so that you can get it.
Yeah, and a general rule of thumb, the higher you are up the income ladder, probably the more the changes are going to affect you.
For the better.
Probably a bigger tax break, yeah. So the same couple this year, they're not going to itemize because they would have come up with 18,000, probably less, using my example. But now they have the standard deduction, so they're going to use the 24,000. However, what is not on here are the personal exemptions because those have gone away. Mm-hmm. And as you look over here, so that's going to leave us with an taxable income of 26,000. But if you see here, the child credit is no longer 2,000; it's actually $4,000. Okay, and potentially, some of that is refundable. And when we say refundable, when you're talking about a credit, it means that even if you owe no money in taxes, you'll still get it back.
Extra back.
But if it's non-refundable, you won't go below 0. You won't, So this is a partial refundable, up to $600 a child, and then the rest is non-refundable. So they end up owing $1,042, but they're only going to receive the $1,200
As a credit.
as a credit of the $4,000.
So actually, their tax went down, but their credits also went down because they can't take advantage of the whole 4,000, and so their actual refund went down. So I think this is one of the interesting tax increases, kind of on the lower middle class side of things. That is interesting when you see like a lot of the higher income, wealthier people got these great tax cuts, and it was sold like it was going to be good for everybody. But there are these instances on the lower income or on the lower middle class to where even though they still don't have any tax due,
Right.
they had a tax increase.
So yeah, when we look here, this couple is actually having a bigger refund in 2017 than in 2018. Okay, so but again, as Phil said, this is going to affect everybody differently. So let's look at a higher earning couple. So everything's the same. Again, really simple example, but they make $250,000. And so using that same, they probably would have more itemized deductions, but I tried to keep this simple. $18,000 as well. In 2017, they would have received those personal exemptions. So their taxable income would be $215,000. Child, I have here the child credit of $2,000 to start with, but as I write in the sentence here, they owe $47,000 and they will not receive any of that credit because they are over the phase out limits.
Yeah, it used to be like $100 and some $1,000 phased out, right?
Yeah, correct. So, and now it's like $400,000. So anyway, so they owe, in this case, in 2017, $47,000 in this simple example. 2018 though is much better for them. So they're going to get a standard deduction, the $24,000, which will bring their income down to $226,000. They're going to get the whole credit because they're not at the phase-out limits, which start at $400,000. So to start with, they owe $40,000, $914, but they're going to get that $4,000 credit, dollar for dollar. So they're going to end up owing $36,914. Okay, compare that to
$10,000 savings.
$10,000 savings. So the two examples really show that's where you're going to end up on the spectrum. So really, it's going to be a bigger tax break for people who are starting to earn more money. Okay, so that's really it on the individual examples before I get into the business one. But again, it's important to be thinking about these things and talking to your accountant about them and trying to position yourself in the best way possible to grab some of these credits. So anyway, that's that. I will make one more point, though. I found it interesting because there's a lot of back and forth on these tax issues. In fact, what I'm showing you today can still change. It's not likely, but things can change before next year. But they did not raise, the child has to be under 17 to get the tax credit. They were going to make it under 18. They didn't do that. But instead, you get a $500 credit for any independent. So it could be a college kid, it could be a parent. It doesn't matter. There's an additional $500 credit. So keep that in mind. So now let's go back to the businesses, okay? Small business owners.
And this was a change that they did because, one of the initial goals of the tax reform was to lower corporate taxes. And they did that, like you mentioned, like significantly. And then there was like this outcry of people saying, how are you going to give these huge corporations tax breaks and you're not going to give small business owners tax breaks? So this was the kind of the compromise that they threw in there
to make it
to try to
a little more equitable.
Yeah, right. Yeah.
So come back to us real quick because I just want to talk for a couple of things before I go back to the screen here. So like we talked about, corporations get an automatic 40% discount, right? That's because their rate went down from 35 to 21, okay? And as Phil said, so every other business is going to get that. But there are some limitations. And they came up with this list called specified service businesses. And this is what we're going to talk about because if you're not on this list, you're in good shape and you're not limited. You get a 20% income deduction, okay? But most people, or a lot of them, especially that we deal with, are going to fall into this list. So here's the list where you do have a phase out starting for married couples.
Of how much income you can have.
Of how much income you could have, right? It's unaffected for a married couple up to 315, and for an individual.
For example, they call it qualified business income deduction, and so QBI for short. And say you're a manufacturer that makes widgets, and you made $1 million, you get 20% deduction of $1 million, easy peasy. But this list that Tony's going to share with you, it phases out for married people between, what is it, 315 to
315 to
415?
415.
It phases out. So you can listen to this list, and that's the phase.
So here's the list. Healthcare industry, anybody that works with a patient. So if you sell equipment, you're fine. But if you deal with a patient, you're affected. If you're a lawyer, accountant, actuarial sciences, performing arts, consulting, if you're an athlete, and then financial services. Okay, so that's kind of the general list. But there is a rule too that says it doesn't matter what business you're in, if you're the principal asset of the biz, and that principal,
like reputational businesses.
Yeah, the business is built on your reputation or your skill, then you're affected by this as well. So that's going to be interesting with a lot of play in there. It is interesting too that, sometimes, I'm a little bit cynical like most people of government, but somehow engineers and architects, they did something right because at the last
minute,
an
exemption.
They got booted from the list. So
they didn't even get booted from they got an exemption, like an asterisk. Somebody had some good lobbyists there.
Right, exactly. So us being cynical. So yeah. I'm sure it's perfectly legitimate. Yeah. So, but in either case, what I want to do is show you an example, because if you are on that list, there's going to be a lot of planning involved, possibly, depending on where you fall. So let's go back to the screen here, and let me show you the two examples that we have. So number one, we start with, this couple, in both examples, they're married filing jointly. And incidentally, there are some other rules, some ors
We're not trying to get it that complicated.
But, yeah, but we'd be here for days talking about it. So this business owner has income of $335,000, okay? And so in the first scenario, they are $20,000 over the 315. That $20,000 is 20% of the 100,000 phase-out income. So what happens is they calculate the deduction on $315,000 and then lose 20% of that. Okay, if they were to make $415,000, that 100,000 over 315 is 100%, so they lose the whole thing. All right. So if they were just at 315, they would have made the 63. But that restriction on the deduction makes it so they are only going to get a deduction of $50,400. So what could we have done differently? Well, in this particular instance, it's possible that the business owner instead could have put $20,000 into a 401k, and their income, if it was pre-tax, would have brought it down to $315,000, and therefore they will receive the full $63,000. So in pure numbers, instead of having only $50,400, they're going to get $63,000.
Plus, it's a double whammy because they got a $20,000 deduction on the contribution. Plus, they're going to get the full QBI. So it's more than just, the extra deduction that they're going to get on there. So that's important. But you have to do this. You need to plan ahead.
Yeah. And this is a simple 401k example. We're often with our small business clients, there is a lot of flexibility in retirement plans, and that's why this planning is so important. So even potentially if you're over the 415 mark, you still might be able to get down below the 315 in some instances.
Institute a pension or make a capital investment that's deductible. Or we have clients that sometimes their income goes up and down, and sometimes it might spike higher. How can we get it to come down lower in those higher years? And then when their income's lower, how do we make it actually higher to get more of the QBI? And I think that's your next example.
Yeah. Right? So, yeah. And so in this case, this is a business owner, and the income is going to end up being $290,000. But they are somebody who had taken, potentially they had taken a pre-tax contribution, lowering their income, and therefore missing out on, in this case, $25,000 of that 20%, right? And so that could be pretty big. So in this case, 8% of that deduction is lost. So instead, if you had not made a pre-tax contribution, looking at the example here, instead the owner makes a $20,000 Roth contribution, or $25,000.
Just bump the income up to $315,000.
They get it up to $315,000. Now they're going to get the full $63,000 deduction. So you're going to get more of your contribution paid for.
The biggest takeaway from this is if you plan ahead with your financial planner and your tax professional, you can engineer your income to be, a lot of times, close to where you want it to be. But But now you really, if you're a business owner, you need to be thinking ahead when you hit into the fall of the year to say, where am I on this to kind of maximize things, because you could be talking about, thousands and thousands of dollars in different in tax scenarios if you had made a few changes. And the Roth contribution has to be made in the calendar year.
Right.
And so you can't do that, up to April 15th when you file your taxes. Sometimes you can't, if you are a business owner and you know about, your profit sharing contributions and what so. So you need to think ahead. And if you don't have a plan set up because you weren't as worried about it before, it could become really important. You need to get these plans set up ahead of time.
Right. So anyway, I hope we're back now off the screen to Phil and I. But these are just some simple examples. And it can be a lot more complex than this for people. So we can't stress enough how much that planning does matter. So you need to look at that and do it. So for our clients, if you want to learn more about our tax program, you can just go to rftaxes.com, and that will walk you through what you need to be done, because we do taxes for our clients.
So rftax.com. We should have posted it right below too, so you should hopefully be able to click on it
right now. So, but the point of this is, finalizing your taxes is going to be a lot simpler, but the planning is going to be a lot more intricate. You've got a lot more going on, and you're not going to have consistent earnings every year. So you're going to have to alter what you're doing on a yearly basis going forward with this. And by the way, the corporate tax rate change is permanent. These have the sunset provision, and they expire after the 2025 year. So,
and for a lot of our clients, tax preparation is going to be included automatically now at no extra cost. So that is one of the things for most of our clients, it is going to simplify. So it makes it easier for us to do it at a lower cost. And that's why we've kind of baked it in. We still have partnerships with two bigger CPA firms, HBK and Harper and Company, that when we do have clients in more sophisticated situations where they may need multiple CPAs that specialize in different areas, or a tax attorney, we have those relationships. But again, regardless of who you use, we hope this helps you. It was oversimplified, obviously, if you're a tax professional watching this. But again, we're trying for just regular people to kind of get some concepts so that it makes you aware that there are some things that you could and probably should be doing.
Yeah. And as Phil said, we try to simplify this. I talked faster in this than I normally do, just to try to get through all these things. So there's a lot of things. Just make sure you're talking to your tax accountant about it.
And if you have questions for us, feel free to give us a ring or a chat or an email to Tony. All of ours are just our names at rebelfinancial.com. So Tony at Rebel Financial, Phil at Rebel Financial. If you just have general questions, support at Rebel Financial, or comment on the social media or so. We're pretty responsive on that.
So, well, thank you for listening. Have a great weekend.
Yeah,
who's up
absolutely.
next week?
Next week's Thanksgiving, so you guys take a break.
That's right. I knew I was missing something.
Yeah. So. Well, eat some turkey. Have a good weekend, and we'll see you a week after next.
All right, thank you.